For On the Radar, where we ask an investing professional what they're looking at in today's markets. We're back with Kash Pashootan from First Avenue Investment Counsel to talk about what can be some misleading headlines, Kash, in terms of the movement of major market indices. If people simply look at the headlines, they'll see that the S&P 500 in the States is up 8% so far this year. The NASDAQ is up 20%. Here at home, the S&P 500, the S&P TSX Composite Index is up 4%. But market breadth is an issue, particularly in the U.S.
Absolutely, Paul. You look at your investment statement or look at the headlines, and like you said, so far this year, the largest market, U.S. being up 8%, it's easy to feel pretty good. But for us as investment professionals, it's about digging further and deeper into it. And when you look at that 8% year-to-date return in the S&P 500, it certainly doesn't tell you the full picture. As the name suggests, S&P 500, there's about 500 companies on the U.S. market, but 85% approximately of that return year-to-date has come from 5 stocks.
That's unbelievable.
Yeah, it really puts it into perspective how the market isn't as healthy as it appears to be at the surface level, just looking at what did the index do year to date. So out of 500 plus stocks, 5 of them were 85% of the return. So the other 495 basically haven't done a whole lot. And so we're very reliant on those 5 names to perform. And then when you look further, the market is also telling you that we still have not rolled over out of bear market territory. The risk-off assets are still in favor. For example, this year, from January until now, U.S. Treasuries are up 3%. They've rallied. You're seeing overall sentiment still focused on risk-off asset. Gold is up 7%. This is not characteristic of a market that's entered into a recovery and heading towards a bull market. And the risk-off asset, or the risk-on assets, I should say, are in decline, right? Copper is still off 25% from its highs. Oil is still off 45% from its highs. So when you dig deeper, there's quite a bit of evidence that states that we're still in a risk-off environment. And so for us at First Avenue, historically being conservative, but also taking this data, our portfolios are positioned fairly conservatively. So what does that mean? That means that we're overweight Canada. We're about 60% Canada, 40% U.S., which is really, in some ways, out of character for us because the last decade, we've been essentially 2/3 U.S., 1/3 Canada. But for the last 2 years, we've been heavier in Canada, and we continue to be. And you're seeing it also in the measure of volatility within our portfolio. So we run a few equity portfolios, and our beta today is from 0.7 to 0.9. So what does that mean? That means how volatile is that portfolio relative to the market? Whereas that 0.9 being our most volatile portfolio is historically been closer to 1.5, so 50% more volatile than the equity market. And again, it speaks to how we have a defensive positioning currently.
We got a couple of Canadian stocks that we'll talk about in just a second, but what does this what are your thoughts on tech exposure? I mean, the 5 stocks that account for 85% of the advance in the S&P 500 are all tech stocks: Apple, Microsoft, Nvidia, Meta, and Amazon. So in this uncertain environment, what are your thoughts on the type of exposure investors should have to tech?
It really comes down to risk appetite. So it's interesting that this year, 85% of the market, U.S. market's return has come from tech. That's been similar, not to that extreme, but that's been similar for the last few years. Most of the returns have come from the tech names. So what does it mean? It means as an investor, if you're trying to beat the market, you have to take outsized risk, because when you have 5 out of 500 companies generating 85% of the return, to beat the market, you have to have an overweight in those names. And some investors will do that. For us, being a pension-style conservative manager, we're not looking to beat the market in this environment, because the only way to do that is you have to be comfortable exposing your clients to outsized risk. We like tech, and we've had exposure to technology, and I think that's where a lot of the world's growth is coming from. It's just a matter of what's your exposure? Are you overweight, market weight, underweight? So we will look at rotating back more heavily into tech, and as we start to get some of the signals that the market is turning around, and our equities team has a great bull market roadmap that we've communicated to our clients, but the metrics are just not there yet to suggest that we're sort of getting closer. You're never going to time it perfectly, but the metrics are simply the check boxes, the green lights have not gone off yet to say that we're close to getting to that stage.
Okay, the two stocks we want to talk about, Canadian stocks that you own on behalf of clients, Fortis, the utility company, and Loblaw, the grocery giant.
Yeah, so listen, Fortis is, you're talking about a utility name, power generation, that's diversified. They're doing business in New York City, but they're also doing business in Ontario and in British Columbia. It's a regulated industry, so really you're just clipping yield in that space. And again, in an environment where you're thinking about volatility, because volatility is often what causes investors to pull the plug if they can't live with it, a name like Fortis has a beta of 0.5%, 0.5. What means that it's half as volatile as the market is. So when you're building a portfolio and in an environment where you want to be defensive, lower beta names are important to consider, and Fortis fits that bill. Loblaw is a name that we like. I mean, again, it's this move from the need to have as opposed to want to have, and Loblaw fits that bill. When people are feeling good and spending money, a lot more money is being spent on Uber Eats. As we're trying to hunker down and save money, we're cooking more at home. Loblaw having the largest, among the largest market share in the grocery space has certainly benefited from that. Having the President's Choice brand allows them to have much more control over pricing. So there's a lot of sort of boxes that are checked at Loblaw. And again, we're not pounding the table saying you're going to get rich owning these names. We're saying in an environment where you want to be defensive, these are some of the type of names that you should consider that we own currently for ourselves and for our clients.